Today is Thursday, September 17th, and this is a post-market review for the stock market activities today. Looking at the agenda of the day, we will cover the closing of the market, the sector's performance, the futures market, the options market. We don't have a lot of headlines today, so we'll skip the headlines. We'll go to the heat map analysis, the rotation, trade update, and then we'll spend a little more time in the charts because the next few days are very important and the technicals will play a significant part in which direction the market will choose to take. So here we go, the Dow Industrial Average in the red, 130.40 points or a decline of 0.47%. The Nasdaq leading the decliners, 140.19 points or a decline of 1.27%. What about the S&P 500 in the red too, 28.48 points or a decline of 0.84%. Moving on to the sector's performance, the gold medal goes to industrials, the silver for materials, and the bronze barely to healthcare. Meanwhile, the laggards of the day, real estate did pretty well throughout the week and today gave up a lot of the gains it had. Consumer cyclicals, communication services, weaker today. And moving on to the futures market, leading the day, crude oil. Crude oil continues to gain and reverse and rebound from the big decline it had earlier. And of course, that goes hand in hand with sugar. You see massive movement in sugar the last few days to the upside, and sugar trades sometimes in relation to oil, specifically when it comes to the country of Brazil. It has a significant impact on the futures market because the use of ethanol in Brazil. And of course, we see lean hogs rebounding from the decline yesterday, cattle and grains in the green. And the decliners of the day, lumber continues to weaken, coffee trying to find a bottom, and of course platinum, palladium overshot to the downside, gold, silver muted, and of course the only metal that managed to close in the green is Mr. Copper. And moving on to the gamblers market, the options market leading the day. Per usual, Apple 2.2 million options traded today. We're seeing an uptick in volume. And of course, the calls here, 58%. Number 2, Tesla, 1.17 million options traded today. 60% of those were calls. General Electric, the Robinhoodian crowd is trying to make a gamma squeeze here with General Electric. They've been successful so far, but they want to push the game a little further. They're going 600,000 options traded today. 82% of those were calls, most of those expiring tomorrow. So they're trying to squeeze more and more. That could fire back, of course, tomorrow. And of course, before we move on from the options market, let's discuss the maximum pain theory. You might be aware that tomorrow will be quadruple witching day, in which, of course, option contracts expire across a variety of equities, ETFs, and futures. And we usually see an uptick of volatility and a lot of funny business during quadruple witching week, but specifically quadruple witching day. The maximum pain theory states that option writers try to manipulate the market to settle certain stocks and the market as a whole in a price where the majority of call options buyers and put options buyers witness their contracts expiring worthless. Of course, there is a magic number for the maximum pain, but you wouldn't know that if you are not writing those options. But you can look at the data and figure things out. And of course, when I do the homework, we have seen an uptick in Apple options volume expiring this week, specifically for the 110 call and 110 put. And of course, the majority of the open interest, the highest open interest, is in the 112.5 call. Option writers, of course, are interested in making the majority of these contracts expire worthless. So they will try to keep Apple at the 110 level. And when it comes to Tesla, of course, the majority of contracts were open for the 450 call. That is the 450 call, and of course the 400 put. So option riders have a little bit of a wiggle room here when it comes to Tesla to exercise maximum pain. All they have to do is closing Tesla stock anywhere between 450, under 450, yet above 400. They will try to do that to make sure they collect your money and leave you holding the bag. However, there are many other factors that will determine the destiny of the market tomorrow beside the tug of war between option riders and options buyers. We'll talk about that in details in the conclusion of this video. But for now, we will move on to the heat map analysis. And you can see that although the indices, the closing looks a little scary, down over 1% in the NASDAQ, red day for the Dow, red day for the SPY, red day for the IWM. Yet when you look at the map, it was pretty much muted. You saw some of the big box names, Apple and Facebook and Tesla, taking it on the chin. But we also saw certain strength in industrials, healthcare, materials, and all in all, I would describe the action in the market today as slightly negative. We're not seeing any panics here. You saw the buying of the dip happening a lot today. We'll talk about that in the charts analysis. But for now, moving on to the rotation trade, and you can see red across the board, no rotation today. And of course, what caught my attention here, look at names like Zoom and Peloton closing in the green, which tells you that we are not through the correction yet. There could be an exodus from the big ticket names like Apple and Amazon and Facebook to raise cash and perhaps consider rotating from one sector to another. But the momentum and the gambling is still well and alive. And the sentiment is very important here because I'm not seeing any fear here, significant fear at least. And the sentiment here is it is just a little bit of a correction, a dip, and it is an opportunity to buy and hop back in the momentum names. We will see how that ends. And moving on to the charts analysis, starting with a chart of the SPY, the S&P 500 from a daily perspective. And here we go. As we can see, we got rejected from the resistance yesterday, right about here, around the 342.50 level. And we had the support right here at about 333. We've been talking about these levels for days now. And as you can see, traders decided that this is good enough for support, and the SPY caught support today. Whether that's going to hold or not, it depends on many other factors. For example, going back to the example right here of about August 2019, everybody thought that this was a bear flag and we are destined to take another leg lower. Yet you saw the SPY catching support once, and twice, and a third time, and finally moving higher. A very different case right here, November of 18, consolidating, catching support once and twice, a third time, and then the failure. And there are so many different aspects that will determine which conclusion we will reach here in our consolidation. But make no mistake, the market has a destination in mind, and it will reach that destination sooner or later. The tug-of-war between option riders, option buyers could delay the inevitable one way or the other. However, the technicals in this stage of the market will be supreme. And the technicals say here that we need a retracement at least back to the line here, the support line of 323. Likewise, let's take a look at the daily MACD. And I usually don't look at the daily, I look at the weekly because the daily has very little significance. However, let's take a look at the look right here after we flushed down during the coronavirus correction and then we rebounded. Let's see the look, how it correlates in the MACD. As you can see, crossing the average, making red impressions, fooling everybody that we are recovering, we're about to cross, and then you see the turn right here, the curling down, and the MACD says, oh wait, there's more. And you see the market flushing down. We're seeing a similar look here where we're supposed to cross and march closer toward the blue line, and that would be the end of the correction. But the daily chart says, oh wait, there is more. And looking under the hood, you can see from the 15 minutes chart today's activities in action, starting with a big gap down, catching the support right around 333, bouncing, very big bounce. And you saw, of course, the Robin Hood idiots and the gamblers and the buy the dip crowd Of course, any dip is seen by them as an opportunity to buy, and they go Naruto style, heads first, running and stampeding to buy the market, taking it higher. And then, jokes on them, the market flushes down, and what do you know? A lot of shorts get excited here. They start shorting the market, and the market smack them in the mouth, rallying, catching support, and it goes back and forth, back and forth. And at the end of the day, you see the short covering and some of the buying anticipating a higher open tomorrow. This is, of course, the process of shaking out the weak hands, giving mixed signals and making those daily or day traders rather shaking off the market. Therefore, you have to have a bigger and macro picture for now. You want to play the micro picture, you want to play the day-to-day, tick-to-tick action, you will be buried alive. The big picture says here's a primary move, consolidation, and a continuation and a resumption of the move lower. But make no mistake, we can go as high all the way to the gap and beyond before we flush down lower. So you have to keep your eyes on the big picture. Moving on to the chart of the triple Qs, the NASDAQ, and you see a different picture here. Let's see the low of this candle, which is supposed to correlate with the triple bottom in the SPY. You saw the number right here at around 270, catching support once, twice. We were supposed to catch it today for a third time. We will see if we closed above it or not when we look at the 15 minutes chart. But for now, it doesn't look good. It looks like we failed to catch the support looking at the Qs chart specifically. The low of this candle is about 266.90. The closing price of this candle was 270.45. Our closing today was 270.32. So technically, we are barely above the support line. Yet when we go back, you see a similar look here in the daily MACD. You see the flush down correlating with the flush down in the Qs and the rebound right here, fooling everybody that it's over. And we're ready to cross and trade in the green again. And you see the second leg flushing down, the bear flag and the flush down. And what we're seeing right here could be very similar. Here's the bear flag and of course the rebound, fooling some traders to get in the action here on the upside. And then what do you know? We take a leg down and flush to the southern destination. Here is a 15 minutes chart, and as you can see, the zombie traders in the beginning gapping down, went Naruto style, buying the market. What do you know? A few minutes later, the market flushes down, and all these dummies who bought calls are now losing money. They give up, they sell them, they think the market is going down. Shorts, dummy shorts this time around, hop in, and what do you know? The market rebounds and goes back and forth, and you see the little mini rally at the end, keeping us or closing the market just a hair above the support line. The action confusing everybody. Longs, shorts, trying to shake as many traders out of the market. However, the chart that I like to look at, and the chart I was looking at today, is the NASDAQ futures, because it is a continuous contract and you can see things here a lot more clearly than the triple Qs. For instance, looking at the NASDAQ futures, you can see that it is a lot similar to the SPY, catching the triple bottom in a healthy technical manner. Now remember, when we knock over and over and over again at a resistance level, the outcome and the natural conclusion is we will break above it at some point. We will crack the resistance and rally and rocket to the upside. The opposite happens when you catch support once, twice, and a third time over and over again. The natural conclusion here is not that you're going to break below, but actually you will rebound and rally higher. That is only one perspective of the overall picture. There are so many factors here. There's the bear flag in the macro picture. There's the war in the options market. And of course, not forgetting algos. But let's look under the hood, the 15 minutes chart of the NASDAQ futures. And as you can see here, catching support right away, rallying, coming back, checking and rechecking the support. The support works, rallying and catching a bid right here. It tried to come back. It didn't make it. It just kept going on and on, making a series of lower lows. In theory, that is bullish, but you have to look at the big picture. You're also making a series of lower highs, which will give you the wedge pattern. Here's the upper line, here is the lower line. We could go back and forth until the market decides which destination it wants to go. I know you're looking for an answer. The market is going up tomorrow or going down tomorrow. It does not work that way. You will know watching the action tomorrow, watching indicators, watching the volume, watching the action in the options market. And of course, you have to remove the first action of the first hour and the second hour out of the big picture. We could see short covering tomorrow and then a resumption to the downside again. Or we can see a pop higher that sells off during lunchtime. It always happens that way when the market is trying to trick you during quadruple witching. And of course, here's a chart of the dollar index, which could be a leading indicator to what's going on. Yesterday, of course, we saw the dollar index catching support on the upper channel, rallying, and that correlated, of course, today with a sell-off in the market. Today, we saw the different and the opposite picture in the dollar index, reversing and coming back closer to the upper channel line. So is this predicting and telling us that tomorrow could be a green day in the market, perhaps? Here is a 15-minute chart of the dollar index. We talked about the support right here and the rally, the consolidation, and going higher. And of course, what happened is the dollar reversed, everything going down, and we will see if it will go down again overnight, find some support and rally, or whether it's going to ultimately break the channel and trade in the southern destination. That would be, of course, positive for the market. And last but not least, a chart of the VIX. A lot of traders are frustrated by the action in the VIX. Wait a minute, the market is down and the VIX is barely in the green. What's going on here? And some traders, by the way, message me and say the VIX is in the red. What's going on? And when we dig and ask some questions, I find out that they're trading the UVXY, the most dangerous ticker you can invest in and buy, and it is a waste of time because this ticker, it does not hold on gains. It moves really fast, and it's better off using it to short the VIX, not to buy it and play it to the upside. This is for my personal experience. I reserve the UVXY when I want to short the VIX. If you want to buy the VIX, choose anything but the UVXY. But here is the daily action of the VIX. A pop higher, consolidation, catching support, popping higher, and you see the sell-off right here, checking back at the 20 days moving average. And again, zooming out, this is not necessarily a bearish behavior. It's only bearish if we continue to go down, breaking support. That would be bearish for the VIX. But here's an example from the big pop of the COVID crash. You see the big initial pop, a sell-off, catching support, and then moving higher, another down day before the explosion to the upside. We could be seeing something similar here. An initial leg higher, revisiting of the support line, a pop higher, caulking the gun, and then an explosion to the upside. I remain bullish in the VIX until and unless we break support and we close below it. And of course, let's conclude this video. We do have quadruple witching, and you will see the tug of war happening between option riders and options holders. The interest here, of course, is to keep the market neutral and to keep the market flat for the majority of contracts to expire worthless. The likelihood is they're not going to be able to do that easily. There will be a lot of volatility because we have algos involved in the program here, looking at technicals and important technical indicators. We saw the NASDAQ, at least the NASDAQ futures, holding the triple bottom. So did the SPY. That was, of course, traders bidding on buying the dip, and algos, of course, catching the support for these indices. My hunch is if we do open lower, a gap lower tomorrow, we will trigger a lot of technical triggers and warning signals. Remember, we do have and talked about before about the domino theory, in which stop orders get triggered. So you'll see the futures flush down overnight, triggering sell orders and triggering margin calls, and that will intensify and exaggerate the move to the downside. Where is that number? It is anybody's guess. I don't know, neither do you, but we will find out if we see a flush down in the futures. That could happen tomorrow, could happen next week or the week after, but this is one scenario that is on the table. And it could have happened yesterday, but you saw the rescue, the plunge, protection squad, and that is not necessarily some Fed people or Treasury people. This could be traders. Traders looked at the support level of the triple bottom in the NASDAQ futures and the S&P 500 futures and decided to build support for now. Whether that's going to hold tomorrow or not, it is anybody's guess. But back to my prediction. If we open gapping lower, you will see the buy the dip mentality again. And of course, mix some short covering with that and you will see a rebound of the market a little higher. However, we had, in this case, in this hypothetical scenario, we had 2 big down days and you will see lots of traders not willing to take the risk over the weekend, triggering a big flush to the downside before the close. Now, scenario number 2, let's say that we build on the momentum we saw during the closing bell today, and the NASDAQ and the markets in general gap higher. This will make it easier for option riders to dump a bunch of stocks and move the market back to neutral to exercise the maximum pain theory. All in all, the market will be a war zone tomorrow.
If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.